The stock market never commits suicide. It gets murdered. Hold on to that thought, because by the end of this video, you will understand exactly who the suspects are, what weapon they are holding, and why so many investors refuse to believe the crime is already in motion. We are watching the early chapters of what could become the defining monetary story of this decade, a story built on debt, dollars, and the quiet return of gold to the center of the financial stage. Some analysts are now throwing around numbers that sound almost fictional. Gold prices in the range of $6,000 now, $17,000 an ounce. Silver climbing past $200. If those numbers ever become reality, understand what they actually represent. They do not represent a bull market. They represent a warning siren for the entire global financial system. Today we are going to walk through why permanent inflation became a fact of modern life, why the bond market may be sending signals nobody in Washington wants to hear, why history keeps rhyming between the 20s of a century ago and the 2020s we are living through right now, and why during every gold rush, the smartest money quietly buys the shovels instead of chasing the gold itself. Let's start with something most people never think about, the difference between how inflation behaved before a certain point in history and how it has behaved ever since. For centuries, prices rose during wars and fell again once peace returned. Conflict drained resources, governments printed currency to fund armies, and prices spiked temporarily before settling back down once the fighting ended and fiscal discipline returned. That pattern held for generations. But something fundamentally changed after the middle of the last century. Instead of prices rising and falling in a natural rhythm tied to conflict and peace, they began a slow, steady, uninterrupted climb that has never truly reversed. Economic historians have charted this shift, and the visual is striking. A relatively flat and oscillating line for centuries, followed by what looks almost like a hockey stick, a dramatic and sustained upward curve in prices that simply never comes back down. Multiple forces converged to create that shift. A near constant state of global conflict meant that the wartime justification for currency expansion never fully went away. A newly empowered central banking system took on an increasingly active role in managing the economy, no longer content to sit on the sidelines. The final severing of currency from any hard commodity backing removed a mechanical discipline that had existed for generations, a discipline that once forced governments to at least indirectly answer to a finite supply of metal, and an economic philosophy took hold that treated government deficit spending not as an emergency measure but as an ongoing tool, one to be deployed at the first hint of economic softness rather than reserved for genuine crisis. Layer on top of that an international monetary arrangement that made a single fiat currency the reserve currency for the entire planet, and you have all the ingredients for permanent structural inflation, not inflation as an occasional visitor, inflation as a permanent resident. And here is the part that should concern every saver, every retiree, and every wage earner watching this video. The modern central banking target is not price stability. It is not zero inflation. It is a deliberately chosen rate of ongoing currency debasement, publicly stated as roughly 2% a year, and in practice frequently running well above that target without much urgency to bring it back down before cutting rates again. 2% sounds small. It sounds harmless. But compounded year after year, decade after decade, it means your purchasing power is being eroded by design, not by accident. This is not a bug in the system. It is the system. Now let's talk about what is happening right now, because the headline inflation numbers have been telling one story while the real cost of living tells another. Recent data shows the annual rate of price increases pulling back from a peak reading, dropping from over 4% down toward the mid 3% range. On the surface, that sounds like relief, but slower growth in prices is not the same thing as falling prices. Prices are still climbing every single month, just at a marginally reduced pace. Go to the grocery store, fill up at the pump, and you will feel a very different reality than the official statistic suggests. One widely cited seasonal cost comparison, tracking the price of a simple cookout for a handful of people, hamburgers, chips, and drinks, showed costs up over 10% from the prior year. That is not a 2% world. That is not even a 4% world in the places that matter most to ordinary households. Part of the disconnect comes from what the official inflation measure leaves out. It captures sales tax, but it ignores income tax, capital gains tax, and estate tax, all of which quietly reduce what a household actually keeps and can spend. It is a useful directional indicator, but as a true measure of the cost of living, it consistently understates the burden that families are carrying. And that burden has political consequences. The affordability crisis, the gap between what people earn and what they must spend just to maintain their existing standard of living, has become the single most volatile issue heading into upcoming elections. Voters who were once primarily worried about job security have shifted their anxiety toward a much more immediate concern, whether their paycheck will stretch to cover next month's bills. Historically, this kind of persistent affordability pressure has been enough to shift control of legislative bodies, regardless of which party happens to be in power when the bills come due. So why does this matter for markets, and specifically for gold and silver? Because the price of gold has long functioned as a referendum on confidence in paper currency and in the institutions that manage it. When confidence in a currency's long-term purchasing power erodes, capital does not simply evaporate, it migrates. Historically, it has migrated into hard assets, into productive businesses, and into precious metals that cannot be created out of thin air by any central authority. That is precisely what we are watching unfold today, with gold trading near critical long-term technical levels and showing renewed strength after periods of consolidation. Now, about those eye-popping price targets making the rounds, numbers like $6,000 an ounce or even $17,000 an ounce for gold, with silver mentioned in the same breath at levels of $200. It is worth pausing on what those numbers would actually mean if they materialized. They would not simply represent a great trade for early investors. They would represent a full-blown loss of confidence in the world's reserve currency, a monetary event on the scale of a true systemic crisis. Anyone cheering for gold at those levels should understand what they are actually rooting for, because a world with gold at $17,000 an ounce is a world where something has gone seriously wrong with the plumbing of the global financial system. That said, skepticism about extreme price targets is healthy, and it is worth remembering that similarly dramatic warnings have circulated before without the system collapsing. Just a few years ago, when gold traded in the range of $1,500 to $1,700 an ounce, plenty of commentators warned that a move toward $5,000 would signal the end of the financial world as we know it. Gold has since moved well beyond that level, and while there has certainly been turbulence, stress in regional banking, volatility in bond markets, elevated government borrowing costs, the broader system has not collapsed. Markets, and gold in particular, have a well-documented tendency to overshoot fundamentals in both directions, the same way equity markets can become wildly overvalued during a mania and wildly undervalued during a panic, without either extreme reflecting a permanent new reality. Gold's rise from those lower levels reflected genuine currency devaluation and safe haven demand, not necessarily an imminent doomsday scenario. The lesson from history, specifically from the last major gold bull market decades ago, is instructive. Gold spiked dramatically during a period of runaway inflation. Then a newly aggressive central bank imposed a punishingly tight monetary policy. Rates rose sharply, and gold entered a bear market that lasted roughly 2 decades. If today's central bank leadership follows a similarly disciplined path, gold could face real headwinds even amid ongoing inflation concerns. The wild card is whether policymakers actually have the political appetite to repeat that kind of aggressive tightening in today's environment, given how sensitive markets and the federal budget itself have become to higher interest rates. Let's shift now to what may be the single most important structural risk hiding in plain sight, the sheer scale of government debt and what it will take to keep financing it. National debt levels are now approaching a staggering $40 trillion, and the government must refinance roughly $7 trillion of that debt every single year, a figure that continues to climb. Perhaps most alarming, interest payments on that debt have now surpassed the entire defense budget. Read that again. The cost of servicing past borrowing is now larger than the cost of the military. That is not a sustainable trajectory for any nation, regardless of the size or strength of its economy. Here is the scenario that keeps serious market strategists awake at night. At some point, buyers of government debt, domestic and international alike, may simply demand a higher return to compensate for the risk of holding that debt. If demand for long-term government bonds weakens, interest rates would need to rise sharply, not because a central bank chooses to raise them as a policy tool, but because the market forces are repricing to attract buyers. That is a fundamentally different and more dangerous kind of rate increase, one driven by necessity rather than by design. There is a historical precedent for exactly this kind of currency and bond market stress. In the early 1990s, one European nation facing a currency crisis was forced to raise short-term interest rates to an almost unimaginable level, briefly touching triple-digit percentages purely to stop capital from fleeing the currency. It worked, but the economic pain that followed was severe. The scale is different, and the country in question is not the issuer of the world's reserve currency, but the mechanism is the same, a loss of confidence forcing an emergency response through interest rates. The United States occupies a unique position because its currency remains the world's primary reserve currency, which has historically allowed it to export some of its monetary inflation abroad rather than absorb the full impact domestically. That privilege has provided a cushion for decades, but privileges like that are not permanent, and there are signs the cushion may be thinning. One of the clearest signals comes from the behavior of central banks around the world, many of which have been quietly and steadily accumulating gold reserves rather than adding to their holdings of government bonds. At this point, a number of central banks now hold more gold than they hold in reserve currency bonds, a remarkable shift from the pattern that has dominated global reserve management for generations. Central banks do not make that kind of allocation shift casually. They are, in effect, positioning for a world where confidence in sovereign debt is no longer something to be taken for granted. Add another layer of complexity, the unwinding of a long-standing currency trade tied to persistently low interest rates in one major Asian economy. For years, investors borrowed cheaply in that currency and invested the proceeds in higher-yielding assets elsewhere, a strategy that worked beautifully as long as interest rate differentials stayed wide and stable. As that country's central bank shifts toward higher rates of its own, the incentive for that trade weakens, and unwinding a trade of that size and duration is rarely smooth. A disorderly unwind could send shockwaves through global currency and bond markets simultaneously, adding yet another potential trigger to an already fragile system. There was also a telling moment not long ago when aggressive new trade tariffs briefly rattled the bond market so severely that a senior economic official reportedly had to intervene directly, warning that continued tariff escalation risked a genuine breakdown in demand for government debt. The tariffs were quickly softened. That episode is worth remembering because it demonstrated something important, that the bond market, not any individual policymaker, is ultimately the check on fiscal recklessness. When bond markets get nervous, policy changes fast. It is one of the few disciplinary mechanisms left standing, alongside the reaction of stock markets themselves, both of which tend to punish excessive inflation and excessive borrowing more effectively than any political debate ever could. Now let's pivot to equity, because despite everything we have just discussed, there remains a compelling and historically grounded case for continued strength in stocks, particularly in technology. Many strategists have drawn a direct parallel between the current decade and the boom years of exactly 1 century earlier, and separately to the technology-driven bull run of the 1990s. Chart patterns in major technology indexes today bear a striking resemblance to that earlier decade's trajectory, suggesting, if the pattern holds, that the current boom may only be roughly halfway through its full cycle. Advances in artificial intelligence, space technology, drone systems, and broader defense spending are cited as the legitimate economic engines driving this expansion, comparable to how electrification, radio, and mass production drove the boom 100 years ago. There is an important historical caution attached to that optimism, however. The boom of a century ago was followed by a devastating collapse and a prolonged depression. Whether today's boom ends in a similarly severe correction or a more orderly cooling remains an open question, but the parallel is too strong to ignore entirely. One popular framework for understanding these cycles borrows from a school of economic thought that emphasizes how artificially cheap credit fuels speculative excess. Years of historically low interest rates, especially in the aftermath of the pandemic, created the monetary fuel for today's technology boom. Picture it as a mix of genuine innovation and speculative excess growing side by side, wheat and weeds sharing the same field. The wheat represents real technological progress that is reshaping industries and improving productivity. The weeds represent the froth, the overvaluation, and the speculative excess made possible by that same cheap money. Eventually, the two get separated, usually painfully. History offers a fairly consistent playbook for how that separation tends to happen. It is rarely the boom itself that triggers the bust. It is almost always the central bank's belated attempt to rein in the excess. Aggressive rate hikes designed to fight inflation that end up popping the speculative bubble as a side effect. That is what happened heading into the technology bust at the turn of the millennium, and it is what happened again in the run-up to the global financial crisis roughly a decade later. If that pattern repeats, the eventual end of the current bull market will likely be triggered not by the technology itself failing to deliver, but by a policy response to inflation that inadvertently ends the party. Some strategists believe today's most richly valued technology names could theoretically fall by half in a future correction and still not be considered cheap, an unsettling reminder of just how far valuations have stretched in certain corners of the market. Despite that long-term caution, near-term corrections should be kept in proper perspective. A true bear market, by most conventional definitions, requires a decline of roughly 20% or more from a peak. Recent pullbacks in technology and semiconductor indexes, while sharp and unsettling in the moment, generally fell short of that threshold and were followed by fairly swift recoveries. That is a meaningfully different animal than a structural bear market. Minor corrections like these have historically represented buying opportunities rather than reasons to abandon a long-term thesis, provided the underlying growth story remains intact. It is worth pausing here to revisit one of the most dramatic single-day events in modern market history, a crash that occurred in the autumn of 1987 when major stock indexes fell more than 20% in a single trading session, a decline that has never been repeated since, before or after. At the time, a combination of investor complacency, a surge of amateur enthusiasm for stock picking fueled by popular investment books, and the early rise of computerized program trading created the conditions for a cascading, self-reinforcing sell-off. In the aftermath, regulators established new mechanisms specifically designed to prevent a repeat, including coordinated intervention protocols and automatic trading halts that pause markets when declines accelerate too quickly within a single session. Those safeguards remain in place today, and they are a large part of why, even during severe stress like the financial crisis or the sharp pandemic-era sell-off, single-day declines have never come close to matching the scale of that one historic session. Deep bear markets of 30, 40, even 50% are still entirely possible over longer stretches of time, and gold and mining stocks have experienced comparable drawdowns of their own during difficult stretches. But the specific mechanics of a one-day, panic-driven collapse of that magnitude appear to have been meaningfully curtailed by the structural changes made since, turning to the broader pattern of market growth. One striking observation is how often major equity indexes have effectively doubled over roughly 4-year windows across multiple recent cycles. That kind of repeated doubling naturally raises questions about sustainability, and it is a legitimate point of caution. But it echoes a similar pattern observed during the 1990s boom, when a prominent central banker famously questioned whether markets had become irrationally exuberant, only to watch valuations climb dramatically higher before the eventual reckoning arrived years later. Investors who exited early on that warning missed out on some of the strongest gains of the entire cycle. There is a well-known adage among contrarian investors that the crowd tends to be right about the direction of a trend for most of its duration, but wrong at both the beginning and the end. The challenge, of course, is that nobody rings a bell to mark either extreme in real time. This raises a practical question worth addressing directly. Historically, outside of major systemic shocks, broad equity markets have rarely corrected more than roughly 20% purely on valuation concerns alone. The deep, devastating declines, the ones that shave 40 or 50% or more off major indexes, have almost always been tied to an identifiable external trigger, a genuine financial crisis, a global health emergency, a currency collapse, something beyond ordinary market psychology. If that pattern holds, then the real risk to watch for is not overvaluation and isolation, but the emergence of one of those external shocks, precisely the kind of debt crisis, currency stress, or failed bond auction scenario discussed earlier in this video. In other words, the stock market rarely takes its own life through valuation excess alone. It tends to require an external actor, a genuine crisis, to inflict that kind of damage. The market doesn't commit suicide, it gets murdered. So where does that leave an investor trying to navigate both the long-term inflation story and the ongoing technology-driven bull market at the same time? The consistent theme across serious market analysis right now is diversification, paired with a willingness to accept calculated risk rather than hiding entirely in cash, which itself is a guaranteed way to lose purchasing power in an inflationary environment. A balanced approach might include income-generating, dividend-paying businesses, including select names known for consistent, even monthly distributions, positions in energy infrastructure and midstream businesses that tend to benefit from persistent inflation and ongoing demand, and continued exposure to broad technology sector funds for investors who believe, as many strategists do, that the current innovation cycle still has considerable room to run before its eventual peak. There is also a compelling case for looking beyond the most obvious, most talked about technology names and toward the surrounding supply chain, the businesses that provide the components, materials, and infrastructure that the flashier front-facing companies depend on. During a historical gold rush, the most reliably profitable businesses were often not the prospectors digging for gold themselves, but the merchants selling them shovels, pickaxes, and supplies. The modern equivalent applies directly to today's technology and defense build-out. Smaller companies supplying components for drone manufacturing, semiconductor production, electric power generation, and the broader defense industrial base may offer a less obvious but potentially more durable way to participate in the boom, benefiting from the build-out regardless of which individual front-facing company ultimately wins the competitive race. The same logic extends to space technology, where a rapidly expanding commercial sector is creating enormous downstream demand for specialized components, launch infrastructure, and satellite systems. Now let's discuss an economic measurement that rarely gets attention in mainstream financial coverage, but deserves far more scrutiny. A statistic tracked by official government economic data that captures something GDP misses entirely. Gross domestic product measures only final output, the finished goods and services delivered to end consumers. It is, in effect, the bottom line of the economy. But there is another official measure, gross output, that captures total spending across every single stage of production, not just the final sale. Think of it as the top line of the entire economy, more than twice the size of GDP itself, because it captures the raw materials, the intermediate manufacturing, the wholesale distribution, every step in the supply chain before a product ever reaches a final consumer. For an extended stretch, gross output growth lagged noticeably behind GDP growth, even turning negative in real terms for a time, a signal that the supply chain itself was under real stress, likely exacerbated by trade tariffs disrupting the normal flow of intermediate goods across borders. Recently, gross output has begun growing faster than GDP again, a meaningfully encouraging sign that the broader productive economy, not just the final consumer-facing layer, is regaining momentum. Any serious analyst evaluating a business looks at both the top line and the bottom line, sales and profit together, because a healthy top line is what sustains a healthy bottom line over time. The same logic applies at the level of the entire economy. A recovering gross output figure suggests the foundation supporting future corporate earnings is strengthening, not just the surface level number that gets the headlines. That strengthening foundation lines up with another very real, very positive development. Corporate earnings have surged dramatically this year, a jump credited significantly to a lower corporate tax structure that has been in place since major tax reform enacted several years ago. Rising corporate profitability, layered on top of improving supply chain activity, provides a fundamentally sound underpinning for continued equity market strength, separate and apart from speculative enthusiasm around any single sector or technology theme. Bringing all of these threads together, the picture that emerges is neither purely bullish nor purely apocalyptic, and viewers should be deeply skeptical of anyone selling an absolute unwavering forecast in either direction. There are two entirely different clocks running simultaneously right now, and it would be a mistake to confuse them. One clock is measuring the ongoing technology and productivity boom, a genuine fundamentally supported bull market, likely still in its middle innings, supported by improving corporate earnings, a resurgent supply chain, and continued innovation in artificial intelligence, space, and defense technology. The other clock is measuring a slower moving but arguably more consequential structural risk, the sustainability of sovereign debt, the willingness of global markets to keep absorbing enormous volumes of new government borrowing at manageable interest rates, and the credibility of the world's reserve currency over the coming decade. These two stories can and likely will coexist for some time. A booming technology sector does not prevent a debt crisis, and a debt crisis, when it eventually arrives, will not necessarily arrive on the same timeline as a technology market top. That is precisely why diversification matters so much right now, not as a cliche, but as genuine risk management. Exposure to growth assets like technology allows participation in what may be one of the more transformative innovation cycles in modern economic history. Exposure to hard assets like gold and silver, alongside inflation-resistant income streams, provides a hedge against the slower moving but very real erosion of currency purchasing power, and potentially against a more acute crisis of confidence in sovereign debt markets down the road. Neither position alone tells the whole story. Holding both in proportions suited to individual risk tolerance and time horizon reflects a more complete reading of the environment we are actually in. What should every viewer watching this take away as the central lesson? Inflation since the middle of the last century has not been a temporary visitor. It has become a permanent structural feature of the modern monetary system, and treating it as a temporary anomaly is a mistake that has cost savers dearly for generations. Simply keeping pace with the stated 2% inflation target is not enough, because real-world cost of living pressure has consistently run hotter than the official number suggests, meaning investors need returns meaningfully above that headline figure just to preserve, let alone grow, real purchasing power over time. The extreme gold price target circulating in certain corners of financial media Numbers in the range of $6,000 or even $17,000 an ounce should be understood for what they actually represent. Not simply a bullish trade opportunity, but a marker of genuine monetary crisis, a scenario nobody should actually be rooting for, even if they happen to be holding gold at the time. The technology-driven bull market appears to still have meaningful room to run based on historical cyclical comparisons, but it will not run forever, and the eventual catalyst for its end is far more likely to come from a policy response to inflation than from the technology itself running out of promise. And underneath all of it sits the single largest long-term risk to the entire system, a level of government debt and annual refinancing needs so large that even a modest shift in market appetite for that debt could force a much more painful and much less controlled rise in interest rates than anything a central bank would choose on its own. The market is never going to commit suicide on its own. Overvaluation alone, even extreme overvaluation, has rarely been enough on its own to trigger the truly devastating declines seen throughout market history. It takes an outside actor, a genuine shock, a crisis of confidence, a failed auction, a currency unraveling to pull the trigger on that kind of collapse. Understanding that distinction is not about predicting the exact day or the exact trigger. Nobody, no matter how many past calls they have gotten right, can reliably do that. It is about positioning a portfolio so that whichever clock strikes first, the technology boom continuing higher or a debt-driven monetary crisis arriving unannounced, you are not left standing entirely exposed to just one outcome. That is the real lesson buried underneath all the noise about gold prices, inflation charts, and stock market records. Stay diversified, stay grounded in fundamentals rather than headlines, and keep watching the signals that matter most, the bond market, the behavior of central banks around the world, and the slow but steady accumulation of gold by the very institutions that understand better than almost anyone else what a genuine loss of confidence in paper currency actually looks like when it finally arrives. There is one more piece of this puzzle worth spending real time on, and that is silver, which tends to live in gold's shadow in most mainstream coverage despite having its own distinct and arguably more volatile personality. Silver behaves like a hybrid asset, part monetary metal, part industrial commodity, and that dual identity is exactly why it tends to move harder in both directions than gold does. When confidence in currency erodes and investors rush toward hard assets, silver often benefits from the same monetary demand driving gold higher. But silver also carries genuine industrial demand tied to electronics, solar panel manufacturing, and a growing list of technology applications that have nothing to do with inflation hedging at all. That combination means silver can lag during the early stages of a precious metals rally and then accelerate sharply once momentum builds, a pattern that is repeated across multiple historical cycles. It also means silver can fall harder than gold during a broader risk-off event. If industrial demand weakens at the same time investors are fleeing to safety, anyone building a position in precious metals as a hedge against currency debasement should understand that silver is not simply a cheaper version of gold. It is a different animal with its own supply and demand dynamics, and sizing a position accordingly matters. It is also worth revisiting briefly just how unusual the current environment truly is from a historical perspective. For most of the 20th century, precious metals and government bonds moved in reliably opposite directions relative to investor sentiment. When confidence was high, capital flowed toward bonds and equities, and gold languished. When confidence cracked, capital flowed back toward gold and bonds struggled. What makes the current period genuinely unusual is that central banks themselves, not just private investors, have begun quietly rotating away from bonds and toward gold as a reserve asset, even during periods when broader investor sentiment toward risk assets has remained relatively upbeat. That is not normal behavior for institutions that are supposed to be the most stable, most conservative actors in the entire financial system. When the most risk-averse participants in global finance start reallocating away from the traditional safe haven of government debt and toward a non-yielding metal instead, that shift deserves attention regardless of what headline sentiment indicators happen to be showing in any given week. None of this is meant to induce panic, and viewers should be wary of any financial content, this video included, that tries to manufacture urgency purely for the sake of engagement. The honest answer to when a genuine debt-driven monetary crisis might actually arrive is that nobody knows, and anyone claiming certainty about the exact timing is not being fully honest with you. Structural imbalances of the kind discussed throughout this video, mounting government debt, a stretched bond market, a central bank walking a narrow line between fighting inflation and avoiding a self-inflicted recession, can persist for remarkably long stretches of time before anything visibly breaks. Markets have an extraordinary capacity to absorb bad news gradually, right up until the moment they absorb it all at once. That is precisely why positioning ahead of time rather than reacting after the fact matters so much. By the time a crisis is obvious to everyone watching the evening news, the opportunity to position defensively at reasonable prices has usually already passed for long-term investors. The practical takeaway is less about predicting the exact catalyst and more about building a portfolio that can survive multiple different outcomes without requiring a perfect forecast. That means owning productive, earnings-generating businesses that can grow their way through ongoing inflation rather than sitting entirely in cash or fixed income instruments whose real value quietly erodes year after year. It means maintaining meaningful exposure to the technology and innovation themes that continue to show genuine fundamental strength rather than dismissing the current bull market simply because valuations look stretched by historical standards. And it means holding a real deliberate allocation to gold and silver, not as a speculative bet on an extreme price target, but as genuine insurance against the kind of currency and confidence crisis that history shows can and does eventually arrive. Even if the exact timing remains impossible to call with precision, the broader story here is really about discipline in the face of two competing narratives that both happen to be true at the same time. Innovation is real, corporate earnings are genuinely improving, and the underlying supply chain data suggests the productive economy is regaining strength rather than losing it. At the very same time, the debt burden underpinning the entire system continues to grow faster than the economy's ability to comfortably service it, and the willingness of global capital to keep absorbing that debt at low cost cannot be taken for granted indefinitely. Investors who insist on choosing only one of these narratives, either blind optimism about the technology boom or blind fatalism about an imminent collapse, are setting themselves up to be wrong in an expensive way. The more resilient approach acknowledges both reality simultaneously and builds a portfolio that does not depend on guessing which one dominates the headlines next year. Keep watching the signals that matter most in the months ahead. Watch how central banks around the world continue to allocate their reserves between bonds and bullion. Watch whether long-term government borrowing costs continue drifting higher even as short-term policy rates hold steady, because that divergence is often where early stress first becomes visible. Watch whether gross output continues accelerating faster than headline GDP, because a strengthening supply chain tends to support corporate earnings well before that strength becomes obvious in consumer-facing data. And watch gold's relationship to its long-term moving averages, because sustained strength above those levels has historically preceded some of the metal's most durable extended rallies. None of these signals will tell you the exact day a crisis arrives or the exact peak of the current bull market, but together they offer a far more reliable compass than chasing whichever price target happens to be trending on social media this week. Thank you for watching. If you found this breakdown valuable, consider subscribing for more in-depth coverage of gold, silver, and the broader forces shaping the global economy in the months ahead.